Before we begin, we would like to advise that while every effort has been made to ensure the reliability of the webinar content, PRMG's product profiles and their updates are the official statements of PRMG, and in the event of discrepancies between the information in this webinar and the product profiles will always supersede the information provided here. Fannie Mae's HomeReady program is designed for low to moderate income borrowers in underserved or high-cost areas. Unlike many government-insured loans, the HomeReady program provides conventional financing with mortgage insurance that may be eligible for cancellation when the home's equity reaches 20%, offering a great alternative to government-insured financing. Loan amounts may be higher than the HUD county limits up to conventional standard balance limits. The HomeReady product allows for 97% financing for first-time and non-first-time homebuyers. This product allows a max DTI of 50% and credit scores down to 620. Funds for down payment and closing costs can come from flexible sources and gifts are allowed. There is a reduced MI coverage requirement and a lender-paid MI option is available. Rental income from an accessory unit and from boarders is also allowed. This product offers fixed rate and ARM options for owner-occupied purchases and rate and term refinances. 1 to 4 units are allowed, and it can offer better pricing than standard agency products as certain adjustments are waived. Now let's take a look at some of the other requirements for the HomeReady program. An occupying borrower may own another residence at the time of closing. There are homebuyer education requirements and landlord education is suggested. We'll look at the homebuyer education and landlord education further into the presentation. It's also important to point out that income limits may apply, which we'll also look at more in depth later. Eligible property types for the HomeReady program include single-family residences, PUDs, 1 to 4 unit properties, warrantable condos, modular homes, and log homes. This slide also shows some ineligible properties like manufactured homes and leasehold estates. Eligible borrowers for the HomeReady program include U.S. citizens, permanent resident aliens who lives and are employed in the U.S., non-permanent resident aliens who are employed in the U.S. and who also have valid Social Security numbers. Full borrower eligibility requirements can be found in the product profile, which is located on the Resource Center. DU findings for the HomeReady program must receive and approve eligible, and they must indicate that the loan is eligible for HomeReady financing. We don't allow for manual underwriting, and as always, all conditions from the DU findings must be satisfied. This screenshot shows how HomeReady eligibility will be entered in Fast Track 360, selecting Community Lending and HomeReady in the appropriate fields. You'll need to ensure that the DU findings show it's eligible for HomeReady. With DU 10.1 or later, ratios are allowed up to 50% without any additional compensating factors. Income limits for HomeReady cannot exceed 80% of the area median income for the property's location. This includes properties in low-income census tracts. You will want to refer to the website listed here to determine eligibility. Fannie Mae provides an income eligibility lookup tool tips document to help with using their tools to determine the income limits and can be found at the link shown here. You will want to use the tooltips document provided by Fannie Mae for more information on determining the income limits. If available, the limits will be returned in your DU findings. If a match is found, it will show the limit, otherwise additional information is required. The map provides information including FIPS, which is a unique code assigned to geographic areas. The FIPS code only needs to be entered if DU can't determine the income limit by the property address, but it must be entered directly on the DU site, as there is no field to input it into FT360. Here are some examples of eligible and ineligible findings for income limits. If a property contains an accessory unit, the property is eligible as long as the property is 1 unit and the appraisal report shows the improvements are typical for the market through an analysis of at least one comparable property with the same use. Properties with accessory units that don't comply with zoning may still be eligible provided certain requirements are met. For more information, you can refer to the product profile, which is located on the Resource Center. For a purchase transaction, a single-family rent schedule, 1007, is required. And for a refinance transaction, a 1007 lease agreement and explanation for why the lease agreement is being used in lieu of Schedule E is required. Here's an example of when accessory unit income may help a borrower be eligible, as the extra income allows the ratio to be less than 50%, which is the max DTI for this program. This shows how the accessory unit income would be entered into FT360. Here's an example of DU findings feedback for a borrower using accessory unit income.
On standard products, you can only use if a borrower with disabilities receives rental income from a live-in personal assistant, but on HomeReady, the income from a boarder can be used if the requirements listed here are met. The property must be one unit only, and the boarder must have lived with a paid rent to the borrower for the last 12 months. The boarder must also continue to reside with the borrower in the new residence. Documentation to prove residency with the borrower, such as a copy of the driver's license and monthly bills, must be provided. Evidence of payment and rental payments, such as canceled checks to the borrower for the last 12 months, must also be provided. However, 9 months may be provided as long as the rental income is averaged over a 12-month period. The boarder cannot pay rent directly to a third party. And finally, the amount of rental income can't exceed 30% of the total qualifying income for the mortgage. If the rental income exceeds 30%, the amount of income can be reduced so that it's no more than 30%. The income can then be used for qualifying income and the area median income limitations. Here's an example of when boarder income can help a borrower be eligible, as the extra income allows the ratio to be less than 50%, which is the max DTI for this program. This shows how boarder income would be entered in FT360. Here's an example of DU findings feedback for a borrower using boarder income. Non-occupant co-borrowers are allowed up to a 95% LTV. DTI ratio is calculated using the income and liabilities of all borrowers. There is no separate DTI ratio requirement for the occupant borrower. The non-occupant co-borrower doesn't have to be a family member, but they must have a relationship with the borrower and can't be an interested party in the transaction. Income from the non-occupant borrower is being considered for qualifying purposes, so it's also considered in determining whether the loan meets the HomeReady income eligibility requirements. This is an example of when a non-occupant co-borrower can help a borrower be eligible for this product by reducing the ratios to an acceptable level. For one-unit properties with all LTVs, a minimum borrower contribution from the borrower's own funds is not required. All funds that are needed to complete the transaction can come from a gift. For 2 to 4 unit properties with LTVs greater than 80%, borrowers are required to contribute a minimum of 3%. For 1 to 4 unit properties with LTVs less than or equal to 80%, a minimum borrower contribution from the borrower's own funds is not required. All funds needed to complete the transaction can come from a gift. Cash on hand is allowed provided certain requirements are met, as shown here. The underwriter must first be able to support that the borrower is a cash basis individual and that their cash on hand is not borrowed and could be saved by the borrower. There must be documentation in the file to support the underwriter's conclusion, and there can be no indication that the borrower typically uses checking, savings, or other accounts. Finally, evidence is required prior to closing to show that the funds for down payment, closing costs, prepaids, and reserves have either been deposited into a financial institution or are held in an institutional escrow account. They can't be used to calculate reserves. This shows how cash on hand would be entered into FT360. And here is an example of the DU findings feedback for a borrower using cash on hand. Down payment assistance must be approved by PRMG and must meet all guidelines as outlined in the product profile. You can email DPA requests or review the list posted on the Resource Center. The PRMG DPA approval must state that it's eligible for the HomeReady product, otherwise it will need to be resubmitted to DPA requests for reconsideration and reapproval. The underwriter must provide verification that the DPA used on the loan is the same program that is confirmed in the email to DPA requests, or that it's on the list on the Resource Center. They must also verify that it's eligible with the product. DPAs are only allowed with 30-year fixed or the 5/1 ARM, and the 105% CLTV is only allowed on the 30-year fixed. Standard Fannie Mae product has higher coverage amounts for higher LTVs. 95 to 97 is 35% on standard Fannie Mae, and 90 to 95 for greater than a 20-year term is 30%, whereas it is only 25% for HomeReady. Additionally, conventional MI can be canceled once it hits a specific LTV, unlike some government-insured options. Monthly borrower paid and no MI are allowed. Single premium borrower or seller paid is allowed if it meets QM requirements. Financed, custom, split, and reduced MI options are not allowed. Mortgage insurance must have level coverage and declining coverage is not allowed. And discounted coverage that requires additional premium per DU is not eligible. Homebuyer education is required for purchase transactions for at least one borrower only if all occupying borrowers are first-time homebuyers, regardless of LTV, and must be prior to the note date. Evidence of completions must be in the loan file.
For homebuyer education, any qualified third-party provider education provider's course is allowed. Fannie Mae defines a qualified third-party provider as a course that is independent of the lender and where the homeownership education content is aligned with national industry standards or housing and urban development standards. Additionally, Fannie Mae has developed a free online homebuyer education course, which is not mandatory but an acceptable option that meets the required standards and can be accessed at the link shown here. Fannie Mae suggests landlord education for borrowers purchasing a 2 to 4 unit property, but it is not required to be completed. Pricing for this product is available on the rate sheet in Poly and Fast Track 360 and is available for all origination channels. Thank you for taking the time to view this training. If you have any questions regarding the presentation, please email PRMG University at prmg.net.